Hey everybody, so I'm doing some back-to-back videos, and in this video I want to talk about CVS. Now they just reported earnings, and it wasn't all that great, but in my personal opinion I didn't think it was horrible. So let's just talk about the technicals first. So if I'm just looking at the 10-year weekly view right now, I mean the chart looks horrible. So we hit this $110 not too long ago, and now we're all the way down to the $70 region. So if I'm drawing a fib retracement right here from the low to the top right here, it's looking like we want to hit the 67.31 area. So we already cracked through this fib right here, that 61.8 area. So maybe we could even fall even more, and we could go down to this 55.55 area. So there is a little bit of risk here. So as usual, when I am recommending a stock, I always recommend for individual stocks to not make a large allocation size. So me personally, if it's not an S&P 500 top 10 stock, I'm making a 1% allocation. So for this, maybe right now it wouldn't be a bad time to just start buying a few shares, but you do want to accumulate up to that 1% full position. So as of right now, I think that CVS is fairly valued. Do I think that it's amazingly cheap? Not really, but I do think that it's fairly valued. And let me just talk a little bit more about the technicals, and then we'll walk into the valuation here. So if I'm going to go on the 10-year one day right here, I have this anchored VWAP that's anchored to the top right here, and it's pretty much lining up with this 200-day moving average. So that's right around, let's see, what is that? It's about 91.09. And we're also below this 50-day moving average, which is this orange line. And this 50-day moving average is pretty much lining up with the 61.8% fib line from where I drew this low to high pivot. So like I said, we could find some support here at 67.31. Maybe we rebound, or maybe we just continue on lower. But if we're looking at RSI right now, we're a little bit oversold. We're at 31.58 for RSI. If we're looking at the MACD also looks like crap, so it's not really looking too good here. But maybe, since we are on oversold conditions, it's entirely possible that we could just digest this move. We could chop a little bit more, and then maybe we can move up a little bit. But, as far as the technicals go, I'm not entirely sure. But like I said, if it's at 67.31, that might not be a bad area to start just building out a little bit of a position. And then, like I said, also 55.55. In my opinion, that would be fairly valued, even more than fairly valued. I would think that that is pretty darn cheap. So now let's just talk a little bit about CVS here. So I want to go ahead. I want to crack into, this is their Q4 earnings. So, we're going to find out why the stock fell so much. So the first thing I want to do is I'm going to look at their condensed consolidated statements of operations. So basically their income statement. Now we want to focus on year ended December 31st. That is 2022 right here. Now there is this litigation charge right here that you're going to see. It's called opioid litigation charges. Now, CVS, they got caught up in some stuff. And well, essentially what happened is that they took a massive loss right here. So right here, they took a $5.8 billion loss on this litigation charges. They also have this loss on assets held for sale. So this $2.533 billion. Now, that's a lot of money to be losing. So as you can imagine, their earnings were not as good as the prior year. So here, we're going down to it. We're looking at $4.14 billion in net income. But in the prior year, we made $7.9 billion. So yeah, they were doing amazing in 2021. 2022, they pretty much shit the bed. So if we're looking at diluted EPS for 2022, it's looking at $3.14. In 2021, that was $5.95. So yeah, like I said, they had these opioid charges, and it really hit their earnings per share. So when that news came out about all the opioid litigation and whatnot, the stock was pretty much tanking, and it was tanking hard. And you can definitely see that right here. Let me just bring up the chart again. So yeah, right here, right, this was a very short time period. So this was pretty much end of 2022. This thing just fell off a cliff. So yeah, it's pretty much crashed. So obviously, CVS, it wasn't doing too well because of all of these litigation fees and whatnot. That did definitely hit their bottom line. But, let's just talk about better days. So if we're looking at better days here, we just got their earnings report for Q1 of 2023, and this is some good stuff and some bad stuff right here. So right here, they say revised generally accepted accounting principles, diluted EPS guidance from $7.73 to $7.93, and then they revised this downwards to $6.90 to $7.12. So essentially, they said, hey, you know what? The guidance that we gave, it's not exactly going to pan out. And we're going to knock this down about 80 cents per share on both the high range and the low range. But even still, this isn't all that bad. If we're doing forward EPS and forward price to earnings, essentially, right now we're trading at about $70. So if we're expecting about $7 of EPS in 2023, this is trading around 10 times earnings per share. So it's basically trading at a 10 times price to earnings, I mean. So is that expensive? Is it cheap? Is it fairly valued? In my opinion, it's fairly valued because if you're looking at the last 5 years, the average price to earnings ratio for CVS is around that 10 area. So in my opinion, not a bad place to be buying CVS. But is it amazingly cheap and you got to buy it right now? Not necessarily, in my opinion. So, if it does start falling a little bit more, I don't think it's a bad place to be purchasing it. And like I said, they pretty much gave us guidance right here that, they're going to be making this $7 area for earnings per share. Now, let me show you one other thing. Let me do a Control F, and I'm going to type in litigation right here. So I'm going to hit until we get to the consolidated statement of operations right here. Now, notice that the opioid litigation charge, we're not showing anything for 2023. So what that's telling me is that most of this is history. So we paid most of it in 2022. So to me, this is a good sign because that means that earnings per share is going to increase. So if we go back to that 2022, yeah, earnings per share was dismal. It was $3.16. And if we're looking at 2021, it was $6. So not looking too good. So right here in 2023, we are expecting diluted earnings per share to be about $7. So that is a big, big jump from where we were in 2022. So 2022, that was $3.14. If we're expecting $7, that's double the earnings per share, you guys. So you have to look at this more in the future. You got to look at forward price to earnings here. So as of now, I don't think CVS is expensive. I don't think it's ultra cheap. I don't really think that it's deserving this massive sell-off after today's earnings also. I didn't really think that today's earnings was all that bad. I guess the one bad thing, like I said, was that they revised their guidance downwards. But even still, this guidance is pretty darn good compared to what we got in 2022. So one more thing that I want to bring up is when we're looking at the dividend is not that bad either. I mean, it's $2.42, which is a yield of 3.45%. Now, like I said with Stanley Black & Decker, it may not seem like a crazy dividend yield, but you have to remember that the Fed funds rate that we have right now and basically the 2-year notes, the 1-year bills, all of that, that is very short term. If the Fed starts cutting these interest rates, these 2-year notes, the yield is going to go down significantly. So, it's not a bad idea to maybe, get yourself in some equity shares that do provide a lot of dividend yield. And you have to remember that it's 3.45 right now. So obviously, if the price does go up, the yield goes down. If the price goes down, the yield goes up. So these things work in inverse. And if we're just looking at, if we're really just looking at the dividend history, you can see that there is dividend growth here. So you can see, hey, 35 cents here in 2015. And then we move up a little bit. Hey, 42 cents in 2016, 50 cents in 2017. And then in 2018 and 2019, this kind of just stayed stagnant, even in 2020. So not until 2021 did we actually get a bump. And then we got another bump in 2022. So in 2023, when those earnings per share is looking better, are we going to get another dividend bump, which will ultimately improve the yield? So hope you guys enjoyed this video and have a good one.